Hello students, how are you? This is your trainer, SBR trainer Mustafa Mirchawala from Mirchawala's Hub of Accountancy. There is a very short current issue today I would like to discuss with you guys. And there is no guarantee because every time I teach a lot of current issues, even we have other videos of current issue I've already uploaded on YouTube. But this is an additional topic, and to be on the safe side, we are doing this, but there is no guarantee. Yes, there is no article on accaglobal.com for this exposure draft yet, but to be on the safe side, it's just a 15-20 minutes current issue. So for the knowledge, you can keep it in your mind. Okay, right? So let's start. This is related to deferred tax assets and liabilities. Hope you remember you studied temporary difference. You studied temporary difference, remember? And you studied two types of temporary difference. One is what taxable temporary difference, and the other is what deductible temporary difference. Taxable temporary difference, where when they are multiplied by tax rate, they results in deferred tax liability, and deductible TDs results in deferred tax asset, right? Or in simple terms, because of taxable TDs, your future taxable profit increases. That means you need to pay tax in future, and because of deductible TD, you get relief in future, right? Simple terms. That's why for taxable TDs, you need to book deferred tax liability, and deductible TD, you need to book deferred tax asset. Now, students, be very careful. Years back, since years, tax department has given a recognition exemption. Tax department has given a recognition exemption. And what is that recognition exemption? Listen, as per recognition criteria under IS 12, a deferred tax liability is not recognized on initial recognition of asset or liability with no P&L consequence. Listen, this is known as recognition exemption. Since years they have given. What is this? For example, you have bought an asset for cash. So you made the entry asset debit, you made the entry debit asset and credit cash, right? So in this entry there is no P&L consequence. There is no Right now there is no P&L consequences, so no need to book any deferred tax. No need to book. Standard says you don't need to book any deferred tax because there is no P&L consequences, right? They gave you one more example. There is one more example, and that is related to IFRS 16 lessee books, finance lease lessee books. Listen, hope you remember the finance lease. On the day one of finance lease in lessee books, you used to make this entry: ROU debit, right of use debit, and lease obligation LO credit. Okay, so just think about this entry. In this entry, you are going to book asset on the one side and liability on the other side. And right now in this entry, there is no P&L consequence. So when there is no P&L consequence, you are eligible for recognition exemption. You don't need to book any deferred tax on this. You don't need to book any deferred tax on this according to existing IS 12, prevailing IS 12, which is going on. The third example, hope you remember when you guys were doing basic accounting, you were kids in F7 level or previous accounting level. You used to study compulsory disposal cost, or we call it decommissioning liability. So for example, listen, in decommissioning liability, on the day one, you used to make this entry: PPE debit and provision credit. PPE debit and provision credit. Now listen, if you see this entry, PPE debit and provision credit, there is asset on one side, that is PPE, and the liability provision on other side. So listen to me: asset on one side, liability on other side. Right now there is no P&L. Nothing will go in P&L immediately. At initial recognition, there is nothing in P&L. So again, this will also qualify for recognition exemption. Means you don't need to book any deferred tax liability on this. So this was existing IS 12. This is the recognition exemption. Student, read it again. Read it again. Read it again. I repeat, read it again. Wait. Read it again, please. Read it again. As per the recognition criteria under IS 12, a deferred tax liability is not recognized on initial recognition of asset or liability with no P&L consequence. This is known as recognition exemption. This is the previous standard, old standard. Now, what new thing they are bringing? What new thing IASB proposing? ISB is saying that this initial recognition is not correct for certain transaction. For certain transaction, International Accounting Standard Board should lift up this recognition exemption for certain transaction. It looks inappropriate for certain transaction because they say there is a temporary difference exists in certain transactions. So it's better that IS board should remove this recognition exemption. Okay, so they have given two examples. I'll explain these two examples and I'll prove you there is a deferred tax present. There is a temporary difference present in this transaction. So when there is a temporary difference present in this transaction, so we have to book deferred tax, right? This is what International Accounting Standard Board is proposing, that now we should remove this recognition exemption for certain transaction. Okay, I'm going to share two examples with you. The first one is lease contract for lessee. Lease contract for lessee. Now listen. Whenever we acquire an asset on lease in lessee books, according to new IFRS 16, nowadays 90-95% lease are finance lease, except for one or two, except for few cases. 99% leases are now finance lease. Okay, and in that case, let me make the entry. We make the entry ROU debit and lease obligation credit. ROU debit and lease obligation credit. Now, what we do in accounting, open your eyes. What we do in accounting, we book depreciation expense right from the day one. Whenever we started, let us say we are starting from day one, we book depreciation expense on ROU, and on lease obligation we book interest expense. So yes, it affects your P&L. It affects your P&L just from the next day. From the next day, it affects your P&L. So you book two things: depreciation expense and interest expense. Okay, and in accounting books. In accounting books, you are doing finance lease. In accounting books, you are doing finance lease accounting. I'm sure you know this. You know this. You guys are not no more kids. So in accounting books, what two things will go in your P&L? Depreciation and interest expense. Now, when you go to tax department, the tax boys, tax guys, tax department treats all leases as operating lease. Almost all over the world, in different jurisdiction, tax department treats leases as operating lease. So what they say we don't recognize ROU, we don't recognize lease obligation. For us, this transaction is operating lease, and in operating lease, whatever rental you pay, we'll allow you. Rentals paid is allowed. So now use your brain. Rentals paid is allowed. Now use your common sense. Use your common sense. In accounting world, we are booking depreciation expense plus interest. But when we go to tax department, they say we don't allow any depreciation or interest. But yes, we'll allow you whenever you pay the rentals. We'll allow you full rentals. We will allow you complete rentals. Complete rentals are allowed. So my dear students, just think over it. There is a temporary difference because in the accounting difference, the amount is different. In the textbooks, amount is different, and also the time is different. How can the time be different? Let me give you one example. Very easy example. This is your accounting period, 1st January 21 to 31st December 21. Okay, and let us say you took an asset on lease on 1st April. You took an asset on lease on 1st April 21. Okay, and on the day one you made the entry ROU debit and lease obligation credit. Okay, ROU debit and lease obligation credit. Now just use your brain. When you have taken asset on lease on 1st of April 21, so that means you have used this asset in 9 months. In the first 9 months of this account, in the April to December, you have used this asset for 9 months. So when you are using this asset for 9 months, so obviously you need to book the depreciation plus interest expense for these 9 months. You need to book depreciation plus interest expense in accounting books for 9 months, right? But let us say you are paying rentals next year, 1 year in arrears. There is a possibility you pay rentals 1 year in arrears. So when you go to the tax department, when you will go to the tax department taking this depreciation and interest, they say, no, no, we don't accept this finance lease accounting, and we don't recognize these things, and we don't allow depreciation in an interest. So they won't allow anything now. But yes, they will say, listen, that next year we will will give you relief when you pay the rentals. So there is a timing difference. Just use your brain. In the accounting books we are booking expense now. In the accounting books we are going to book expense now, but the tax department will allow in future. So see, this is a timing difference. So when there is a timing difference, why don't you book deferred tax? This is what IASB proposing. This is what IASB proposing, that there is a timing difference from day one. So why you guys are not booking deferred tax on it? That's why they are proposing to lift up this recognition exemption. This is what this exposure draft is. You just need a basic knowledge. You just need the basic knowledge, the game of this. That's it. Giving you 1 minute to think over it. Think over it. Just relax and think over it. Now, giving you one more example. Please just concentrate. 5 minutes more. Please, please. Thank you. Thank you for listening me. Decommission. First, read this as well. Giving you 30 seconds. Read this. Read this example as well. Read this example as well. Read this example. I have explained you in my own words, but you can read it. Now, the second example is decommissioning cost. Let me recall you this topic as well. Hope you remember this decommissioning cost or compulsory disposal cost is what? Sometimes when you buy mining rights from somebody, and you go to dig that mine. So government authorities come and they give you a piece of paper to sign. And what is written in that paper? That whoever will do digging here, whoever will do mining, will have to landscape at the end of year 5. Okay, so there is an obligation right from the day one. There is an obligation right from the day one for that compulsory disposal cost. So remember, we used to make entry for this compulsory disposal cost or decommissioning liability. Students, please, we used to make this entry: debit PPE and credit provision, debit PPE and credit provision. Remember? Now now just think. Wait, we have to pay this at the end of year 5. Okay, we have to pay this at the end of year 5. The payment will be made at the end of year 5. Now, In accounting books, what we do, we book depreciation expense. We book depreciation expense right from the day one. Just the day we start using it, we book it. We book depreciation expense for this PPE, and we book interest, or what we call unwinding of discount for this provision liability, because we have done discounting. We have calculated this provision by doing present value, by computing present value of future cash flows, or what we call it discounting. So definitely unwinding of discount is needed. So students, in accounting books, now my final words, in accounting books, right from the day one, we have to book depreciation plus unwinding of discount, that is interest. So these two expenses we are booking in accounting. Listen, and now we'll go to tax department. Now we will go to tax department and we'll say, sir, please allow this expense. Tax department will say, no, 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 we won't allow anything now, but yes, we'll allow when you'll pay in future. We will allow you to gather everything together in future. So what does it mean? This means there is a timing difference. There is that It means there is a timing difference, because we are booking in accounting books, we are booking expense now, but tax department is giving us relief in future, so there is a timing difference. So when there is a timing difference, why don't you book deferred tax? This is what standard board is proposing. This is what standard board is proposing, students. I hope you got the concept. See, this what board is proposing. Consequently, see, the board is proposing amendments to require a company to recognize deferred tax for temporary differences that arise on such transactions. The proposed amendment would do so by narrowing the scope of recognition exemption. That means they are going to lift up, or they are going to change some of these recognition exemptions, because they think they are not correct. They think these recognition exemptions are not always correct. Okay, so keep this in mind. Maybe it may come. Okay, so this was last moment help for you guys. And work hard, best of luck, and remember me in your prayers. Thank you. Hope you will have an excellent paper. Thank you.